Hello students and welcome to today's class. We are going to start with chapter Working Capital Management Inventory Control. So this entire chapter is going to revolve around how do we manage our inventory so that we increase our efficiencies in working capital. So to begin with, the first basic question that comes into mind is what is the role of inventory in the entire working capital management? Now inventory plays a very crucial role in the working capital management. First being liquidity. Now what is liquidity? Liquidity is how fast an asset is convertible into cash. How fast an asset is convertible into cash. Now if I have to list down, the highly liquidable asset in a company is cash, then is your bank balance, then is your accounts receivable, then is your inventory, and least liquidable being fixed assets. Now, inventory is a current asset, but it also takes time to sell. Okay. So in a business scenario, what will happen? You'll procure raw material from suppliers. You'll work on that raw material and build your product. Then you'll sell it to your customers and take the money. So once you receive the money from the customers, you'll pay out of that amount received, you'll pay to your suppliers and the rest you'll keep with yourself. This is a normal business scenario, right? Now, in case you make excess inventories, you manufacture excess inventories. Now, what will happen? Now, inventories will take time to sell. You won't be able to sell all your inventory at once because it is not that easy to sell, right? It will take certain period of time because you have created excess inventory. Now, you'll receive less amount of money from your customers and you'll have to pay more amount of money to your suppliers. Now, in this very situation, there would be a problem of cash crunch wherein you're receiving in the inflow is less but the outflow is more. So this will result into cash crunch and this will also weaken the financial position of the company, resulting to default in payments, due dates, missing out on the due dates, etc. So the inventory management is very crucial because it also impacts your liquidity. Okay. Second point being profitability. Now imagine in case of Tata Motors, they approximately sell 40 to 50,000 cars in a month. Even if they have a 1 month's inventory, which is 40,000 inventory, imagine the amount of space that they would require to keep 40,000 cars. Imagine the space they would require. It would be a huge space. So more space being, they'll have to rent out more warehouses to keep their cars, correct? Which will increase their rent cost. Now, having 40,000 cars, there is also a risk of what? There is a risk of fire, there is a risk of theft. So what will you do? You'll take an insurance. Now, taking an insurance of 40,000 cars will also increase your insurance expense. Now, what will happen? Your warehouse cost, warehouse rent increases, your insurance increases. This will result in increase in the expenses, which will result down into reduce in profitability. So it will impact your profitability by increasing expense. Now the third point being risk. What is the risk? Risk of becoming obsolete. How does a product become obsolete? Because of technological changes. There is a how did Nokia become obsolete? Nokia became obsolete because of technological changes. People moved to iPhones and Androids, iOS and Androids, and Nokia couldn't capture. Correct. Same as also political policies. Now, for example, let's take that same example of Tata Motors having 40,000 cars. Now, suddenly there is a day that the government comes and makes a changes in the policy, saying that from 6 months from now, there will be no petrol cars to be sold. Now, imagine the situation of Tata Motors. They have 40,000 cars as their inventory, and now suddenly the government changes the policy that there will be no petrol cars from 6 months from now. Now, in this very situation, what will happen? People will stop buying petrol cars. They'll start buying EV cars. And what will happen? The entire 40,000 cars that the Tata Motors have will become obsolete. They won't be able to sell in the market because people won't buy. So the entire money that is being put into the manufacturing of these cars will result into being obsolete. So no money recovered, all into waste. So this is the risk of becoming obsolete because of technological changes or political policies changes. Okay. So this is how excess inventory can create a problem into the working capital management. Now, before we start our next topic, let's take an example. Now, everyone wants to build their own company. People want to do, in today's scenario, people want to do startups. So imagine you came up with the idea, of an EV car. Seeing the current trend, you thought of an idea of a car because you loved cars and you thought of an EV car, correct? So you thought of putting a manufacturing of EV cars and you forecasted a demand. What was the demand of your EV car? Your annual demand that you forecasted for your EV car was 1,20,000 units. 1,20,000 units. Correct? So now you'll require certain components to manufacture this car. You'll require certain components to manufacture this car. Now tell me, what are the components that you'll require? I'll start with certain examples. The first thing that you'll need is what? Steering wheel. The first thing that you'll need is steering wheel. Now give me more examples. To manufacture an EV car, what are the components that you'll need? Battery. Yes, battery becoming the most essential because without battery you cannot make a EV car. So you'll have battery. Then you'll have your gearbox, correct? Then what else? You'll have your mirrors. Okay, mirrors. Then you'll have your wheels. You'll require 5 wheels, 4 wheels for the car and 1 wheel as stepney. What else? You'll need seats. And you'll need there are a lot more components. You'll need infotainment systems. You'll need windshields. There are so many other components that you'll also need to manufacture a car. So this is, I'll put as extra. So these are the components that you'll require to manufacture a car. Now since you have forecasted a demand of what? 1,20,000 units. You have forecasted a demand of 1,20,000 units. Now tell me, you'll need so many components. What is the quantity of these components? What will be the quantity of these components that you will order? Will you order all at once? I want to order 1,20,000 units. I'll order 1,20,000 steering wheel at once. But what will be the problem? The problem you'll have to manage such an excess inventory. And right now we studied what? This will reduce your profitability because you'll need more space to keep those inventories. So ordering all at once will require more space. Okay. Then you'll say, what? I'll order less quantities. Less quantities, what will happen? You'll have to order frequently. Frequently order. Then what will happen? For example, your inventory comes from, your plant is in Gurgaon and your inventory comes from Karnataka. So you'll have to incur transportation costs every time you place an order. So ordering less quantity will result in more transportation cost. Sir, now we are confused about what we should order. Should we order more quantity? Then we'll have a problem of carrying cost, which is your warehouse rent, we'll have to pay extra. If we kind of order less quantity, then we'll have a problem of ordering cost, wherein we'll have to incur transportation cost again, correct? So this is the exact problem businesses faces when they are ordering for the inventory, for their components. So to solve this very problem, there is a concept of economic order quantity. So to solve this very exact problem, there is a concept of economic order quantity. Now, the name itself would define their meaning, being what is, you'll place an order, you'll require what quantity you should place in an order that it is most economical. Correct. Economic means you can say economic means cheapest. So what quantity you should place in an order so that your total cost is lowest or cheapest, correct? Being an ACCA student, after clearing all your exams, what will your objective be? To increase the profitability of company, better working capital management. So you'll have to decide the right amount of quantity that will result into lowest cost, which will further result into increase in profitability. So the economic order quantity means the exact quantity that you should place in an order so that your total ordering cost is minimum, which is your least. Okay. Now, let us once go through the definition. Economic order quantity is the order quantity that minimizes the total inventory cost, that is sum of ordering cost and carrying cost, which is your holding cost. Now, we'll understand what are the costs involved in the economic order while placing an order. So, the cost involved is, first cost is your purchase cost. Purchase cost is the price that you pay to buy an inventory, buy your raw material. Price that you pay to buy an raw material is called your purchase cost. Now, the purchase cost, the total purchase cost in an annual will always remain same. Now, give me an example, sir. I did not understand. For example, let's take a different example. For example, you consume 100 packets of Lay's, correct? 100 packets of Lay's in a year. And you thought of buying that entire 100 packets all at once. So what is the cost of the packet? The cost of packet is 10 rupees. 100 packets, your total annual cost will be how much? 1000 rupees. 1000 rupees. Now you decided that I'll only take 10 packets at a time. So you'll order 10, 10, 10, 10. But you will still end up consuming how much? 100. And you'll pay 10 per packet, which will result in 1000. So purchase price is the price that you pay to procure that product. Now this price remains constant. That 10 rupees price will remain constant whether you purchase 100, whether you purchase 1000. So that price per unit will remain same. So which means your total cost of purchase will always remain same irrespective to the quantity that you order. So that is the very reason why purchase cost becomes irrelevant for a decision. Purchase cost is a cost that we incur, but that becomes irrelevant for decision making, because at an overall level, the cost will remain same irrespective of the quantity we order. Got it? Now, the second cost is ordering cost. As I told you, while you place an order, what will happen? You'll incur transportation cost, you'll have to incur transit insurance. For example, if you have your plant in Gurgaon, and you procure raw material from Karnataka. So every time you place an order, there's a transportation cost that will be involved from transporting the goods, raw material from Karnataka to Gurgaon. There will be admin related cost. And when you're also transporting your raw material from, for example, Karnataka to Gurgaon, you'll also will have to take a transit insurance so that your goods are safe. You are protected in case any damage happens, in case any accident happens. So it will involve transportation cost, insurance cost, transit insurance, and also other cost, admin related cost. Which means the more quantity you order, For example, if you order 1 lakh quantity, so you'll have to place one order. But if you go on reducing your quantity, the number of orders will go on increasing. So more quantity, for example, 1,20,000 units will mean less orders, which means one order, which will result into less cost. Why less cost? Because you'll have to incur that cost only once. And not every time you order. And it will happen vice versa. For example, if you order less quantity, will means more orders, you'll have to pay more orders. For example, if you take, the annual demand is 1,20,000 units and you order 10,000 units at a particular time. So you'll have to place 12 orders. Means 12 times you'll have to take transit insurance, 12 times you'll have to incur transportation cost. So which will mean more cost. Okay. So here, if I'm benefiting when I'm ordering more, I'll have to incur less cost. So if I order more, I'll be in a beneficial position. Now coming to the next cost, that is carrying cost. Carrying cost is also known as holding cost. The cost that you will incur to hold that inventory at a particular period of time, for a particular period of time. So, for example, Tata Motors. Tata Motors, like we took example, 40,000 inventory. So, imagine the space that it would require to keep those 40,000 cars. Now, the space would result into paying rent for that land, for that warehouse, and everything. You'll also have to incur for the safety, you'll have to incur insurance. So more the number of cars that you carry, the more insurance cost that you'll have to pay. Correct? So what will happen? The more quantity, more space, and more cost. More quantity would result into more space that you will require, which will mean more cost. And less quantity, if you take less inventory, if you take for example 1000 cars of inventory for Tata Motors, you will require a very limited space, which would result in less cost, which would result in less cost. You will require less space and you will require less cost. Okay, so there is inverse relationship. The more quantity you order, you will incur what? Less ordering cost. So for example, if I have to draw more quantity, if you pay, you will have to pay less ordering cost and more carrying cost. Correct? Less orders, less quantity, you will have to pay more ordering cost and less carrying cost. So imagine this as a seesaw. What is happening? More quantity, less ordering cost, and higher is the carrying cost. Whereas if you order less quantity, your ordering cost will increase and your carrying cost will go down. Your ordering cost will increase and your carrying cost will go down. So this is a seesaw, which means there is an inverse relationship that will happen. So as we studied in the economic order quantity, what is that quantity that we should order so that total cost is minimum? So this becomes minimum when the ordering cost is equal to carrying cost. This is the very point where the total cost is minimum. Now, through this entire ordering cost is equal to carrying cost, we have derived a formula. Of deriving a quantity which is under root 2 into demand, which is 2 into demand of your annual demand of your product, multiplied by cost per order divided by carrying cost per unit per annum. Carrying cost means the cost that you will require to hold a product per unit per annum. Okay? So through this formula, we would arrive at a quantity. Through this formula will give us the quantity, exact quantity where the total ordering cost will be minimum. Okay, any cases apart from this quantity, any higher or lower will result into extra cost. So as a finance manager that you will become, as a CFO that you will become tomorrow, you will take decision based on EOQ so that your total ordering cost of the company is at minimum, and so that you could increase profitability and put your company at a better financial position. Okay? So that is the entire concept of EOQ. I hope you understood. Thank you.